My name is Benjamin Souza. I am the fixed income strategist for Latin America. I help and support investors that are looking to create investment strategies, particularly in fixed income, be it rates, credit, or emerging markets. Fixed income, we call it fixed income for a very simple reason. You know, a fixed set of cash flows, that is the coupons and the maturity that you're gonna be getting back at some point for your investment. That means that you can invest in bonds of governments or corporates and in local currencies or in hard currencies like the dollar mostly. ETF is simply a wrapper. What that means is that just like in a mutual fund, you are wrapping a series of bonds that have similar characteristics. It could be government securities with a certain term, that is 1 to 3 years, for instance, or it could be corporates that have similar ratings, that is investment grade or high yield. It could be emerging markets, so a series of sovereign emerging market bonds that are just simply wrapped into this ETF. Now, what this ETF means, you are now able to invest in fixed income or in bonds via an exchange. That is, any Brazilian investor or any Mexican investor can go to their local exchange and buy portfolios that are fixed income that you typically don't buy them on an exchange, but now with the ETF wrapper, you have the ability to access them in an easy, efficient, and transparent way. There's always an opportunity in fixed income. Generally, there's two ways to make money in fixed income. The first one is carry. So that is the coupons that you're receiving that generally tends to work really well when after central banks just hike rates, which is what just happened across the world. And then the second opportunity in fixed income, or to make returns in fixed income, is playing with duration. Generally, you want to extend duration when the Fed or a central bank is about to cut rates. And generally, you want to reduce a duration when the Fed or the central bank might hike. Those are the three levers that you can play and can return or can increase your returns in fixed income. When you're investing in fixed income, there are two risks that you care about. The first one is duration. That is, how long it's gonna take for you to get your money back. So that's called maturity. You can invest in bonds that are short maturity, so 0 to 1 year, for instance, or you can invest in bonds that have very, very long maturities, so 20-year plus. You have the ability to pick and choose. What that means in practice for the investor is that when you are investing in very short-term duration bonds, you experience very little volatility. When you are investing in very long duration bonds and rates change, you experience more volatility, right? So you can control how much volatility you want in the portfolio by controlling what term or what maturity you're looking at. So that's the first thing. And the second thing is, when you're talking about credit, that is the ability for the companies or governments to pay you back your money, it's called credit. That is the ability for them to pay or not pay, i.e. default, right? That's called credit. And generally, there's a scale that measures that, like this ability to pay you back. Separated in two big camps. So investment grade means these are companies or governments that have a high ability to pay you back, that is low risk. And then there's high yield, which are companies or governments that you have more of a concern that they can pay you back. Those are high yield. You get compensated for getting that kind of exposure by higher yields, but obviously that means more risk, right? So in an uncertain world, you would be more concerned about the latter than over investment grade bonds. So fixed income plays a role in a portfolio, and this is why people have been putting them in a portfolio for forever. The role is very, very basic. They provide income. You receive a coupon from bonds, right? So that provides income, and that stabilizes your income over time. And second, they tend to be on the lower end of the spectrum of risk, right? So they tend to compensate very well risk assets. So when you're building a portfolio and you're adding equity and you're adding international equity and you're adding emerging market equities, you need to balance those risks with something that tends to be less risky, and that's the role that government bonds, for instance, play in a multi-asset portfolio or in a global portfolio. Thanks. It's great to talk to you, to Brazilian investors and to Latin American investors. I hope you learned something. And again, please reach out to your BlackRock representative if you want to learn or want to get deeper into this asset class.